The real truth is exposed. I'm your host, Steve Metre, and thanks for joining me today. In our show today, the Fed just pulled the trigger. I'm going to show you what they're planning to do and the reasons behind it. And more importantly, why this means it's time to get out now. And let's over to Bloomberg, where we picked today's story up with a headline. As Powell says, the time has finally come for the Fed to cut interest rates. And this is something that we know that Powell wanted to do, because at the last FOMC press conference, he suggested that he wanted to cut rates, but the challenge is he didn't have the full support of his board. So he's using his position as the leadoff speaker at the Jackson Hole Symposium today to set the stage for the other speakers to let them know that he is ready to cut rates and to plan on it at the next meeting. And the time has come for policy to adjust, he said today, as the direction of travel is now clear, and the timing and the pace of rate cuts will depend on the incoming data, the evolving outlook, and the balance of risk. But what is the real truth here? Why is Powell so eager to cut rates, and perhaps why have some of the other members not so eager to do it? We're going to take a look at the underlying economy, and you're going to find out why Fed Chair Powell is extremely worried. The Fed chief also acknowledged recent progress on inflation, which has resumed moderating in recent months after stalling earlier in the year. He says, "My confidence has grown that inflation is on a sustainable path to 2%, referring to the central bank's target." But what is the metric that he's using for that? That's a big question, because not long ago, we heard from him and the other speakers that they were worried about inflation resurging. Now he's convinced it's on a path to 2%. Perhaps it has everything to do with the labor market, which is what we're seeing now as a shift in tone from the Fed. As we look at the consumer price index in blue on a year-over-year rate of change and the unemployment rate, this is the U3 in red. And what do we know? That as unemployment starts to rise, you can get transitory increases in inflation, but it comes tumbling down. And this really makes perfect sense, because as people hit the unemployment line, their incomes go down, and so they have less money to spend in the economy. And that back feeds to, of course, what we see from retailers and wholesalers who need to start marking inventory down to get it out the door. And so what you see is, of course, as the market starts to realize that the labor market is falling apart, inflation comes down. And the challenge now is, we heard not too long ago from the Fed chief that he thought the unemployment rate would stop somewhere around 4.1%, but now it's at 4.3. The fear is it's going to continue to go higher. Inflation is not going to be the problem. It's going to be the economy. Swaps traders held steady in their pricing for the total rate cuts they foresee through the end of 2024 at about 98 basis points. Odds now remain steady for a quarter basis point cut in September. And while the Fed puts on the airs that they are independent and they are the ones setting policy, they look to the markets, and they want to see that the market is telling them that, yes, you need to cut rates and this is how much. Because we know in the past the Fed rarely disappoints the markets, but one of their big fears is they don't want to kick off a banking crisis like we had in March of last year by doing something the market doesn't expect. And so what the market is now communicating to the Fed is, yes, you need to cut, and yes, we're completely ready for it. But not always, but that's the case. Yet just as inflation neared its target, cracks have appeared on the employment front, prompting several Fed officials to worry that high rates now pose a threat to the economy's continued strength. Warning signals included a disappointing July jobs report that rattled financial markets. "We do not seek or welcome further cooling in the labor market conditions," Powell said, adding that the slowdown in the labor market was unmistakable. And now this is the fear. They brought inflation down, or at least they're taking credit for it, and now we're seeing the labor market start to unwind. And this is exactly what happens when you constrain demand. You start to see things falling apart. But one thing that should be unmistakable to the good side, that's your trading account, because right now we have a total of 41 open trades. Our CTA Timer Pro, 85% win rate. Now, how do we do that? When the machines get in deep short position and price rallies against them, we flag it on our reports. And here's the best thing: no matter which report you sign up for, or maybe both, they're 100% duplicatable. You can copy every trade. Let's take a look at Momentum Timer Pro is sitting on an 86% win rate when we see a big pullback in momentum, because we look at this over a 1, 3, and 6 month period by aggregating all these technical signals and with a proprietary overlay. When we see that shift in momentum, well, it flags on our reports. Now here's what you get. all the reports, that you get the tradable signals. I give you my opinions on the trades I think you should do. I give you the stop loss levels. I track the returns, the good ones and even the bad ones. And once a week, we update the stop loss levels. Here's the best part, 30-day free trial and every trade fully duplicatable. Links in the description below for both of them. Jump on them while you can, because when we look at what's going on here, we see the unemployment rate is starting to frighten the Fed chief, and he really wants to cut rates here because he believes, and the market believes, that if you cut rates once or twice, maybe even a little bit more, that's all the economy needs. Is that monetary policy here is far too restrictive. But when we look at history, that's not what happens at all. The problem is once you start to see the labor market fall apart, there's virtually nothing the policymakers can do to stop it. And as we look at the federal funds rate in blue against the unemployment rate in red, what do we see? As the Fed starts to cut rates, it doesn't actually stop the trend in unemployment. In fact, it starts to accelerate it to the upside. You see that happen here again in the dot-com bubble. Unemployment rate started to rise. The Fed gets nervous, says, well, we need to cut rates. And next thing you know, they're just plunging as the unemployment rate goes higher. It happened again going into global financial crisis. You can see very clearly unemployment rate rising. The Fed starts to react, and then it's too late. Right now, that is the fear the Fed has, is they're too late to the party, which is why, of course, Fed Chairman Powell wanted to cut rates last month. The issue here is, while the market believes rate cuts work, history shows they don't work at all. But yes, you got to keep in mind, the Fed needs to keep up the allure that they're actually doing something and they have control over the labor market. Because their success or failure will determine whether there's a so-called, quote, soft landing, the rare feat. I'm not going to say rare. How about impossible feat? It's never happened before. And if you don't think the Fed chief knows it, oh, he does, of smothering a burst of inflation without tipping the economy into recession. And that's a key point, because every time we bring inflation down off a relatively high level, eventually the labor market goes. Because you think about it, how do you bring inflation down? You have to bring demand down. And if you bring demand down, well, you don't need as many workers, and next thing you know, the whole thing snowballs apart. Our objective has been to restore price stability while maintaining a strong labor market, avoiding the sharp increases in unemployment that characterized earlier disinflationary episodes when inflation expectations were less well anchored. So he admits that he understands what's about to happen. And while the task is not complete, we have made a good deal of progress toward that outcome. So what Powell's saying here is, look, I brought inflation down. Now I need to keep the labor market from falling apart. I need to get some rate cuts here on the board to show everybody around the world that we're doing our part to keep the economy humming. But the reason I wanted you to see that unemployment report against the funds rate is because it never works. Not once, but yet they have to keep the mystique up. Because when we look at the consumer price index, you can see against continued unemployment claims, there's absolutely no question when you bring inflation down, what happens is you don't need as many workers. They get onto unemployment. There's no opportunities for them. They get stuck there, and further demand destruction occurs. And you can see this going back to the mid-'80s, the early '90s. How about here, the dot-com bubble, once again, the global financial crisis, and you see it now. There's really nothing changing here, because if we were experiencing a soft landing, we might start hearing from employers that they're looking to hire. We might start to see continued unemployment claims shift a bit. We're not seeing anything of that nature, and Powell knows it, and he realizes if he's too late to cutting rates, first of all, it's not going to work anyways. But remember, he's got to convince everyone it does, and then find something else to blame it on with a time when everything goes wrong. And Powell's comments will likely be well received by Americans contending with higher interest rates attached to mortgages, autos, credit cards, and other borrowing. The problem is they can't refi most of that stuff over a quarter point. That's not going to make any difference. And yes, it will affect credit card minimum payments, but not for several months, because banks tend not to lower rates very quickly, any more than they raise them very quickly. Yes, they'll go down, but the amount of its savings will be negligible, as investors are widely anticipating a quarter point cut when the Fed now meets at the September 17th and 18th meeting. Yes, a quarter point at this juncture is a lock. A half a point? Well, we'll see what happens to the labor market between now and then. But they note that consumers here are confident and looking forward to a rate cut, but perhaps they're not. Because when we take a look at the University of Michigan Consumer Sentiment Survey shown in red against the federal funds rate in blue, you can see, yes, the idea of the Fed cutting rates, people believe it, but in practicality, as the Fed cuts, the economy gets worse because the labor market falls apart, and you can see confidence wanes and heads lower. And you can see that at virtually each and every time the Fed cuts rates. Now, there's times they talk about it, confidence stays up, and then they cut and confidence comes down, because what it means is the economy is indeed falling apart, and we're about to see that now in the coming months. And by the time we get to that meeting, yes, will the Fed cut? Absolutely. Will it make a difference? Well, it's going to make things worse, and a whole lot worse. Investors are weighing whether another negative jobs report would compel the Fed to cut rates by a larger than usual 50 basis points in September. Another key matter is how policymakers might proceed with the pace and size of rate cuts in subsequent months. Powell said, and policymakers will do everything we can to support a strong labor market as we make further progress toward price stability. But of course, he's never going to say what the actual plan is, because he doesn't know. They're going to wait until the meeting. They're going to look at the data, and then they're going to come out and make a decision. We know at the very least it's 0.25%. But if he goes to a full 50 basis point cut, in past history, it shows that they know things are far worse than we believe. And yes, by the time we get to the election, as I've suggested, we're going to be in a full-on recession. And even Fed's Bostic, now getting in line, says he might favor more than one 2024 cut. Now remember, a lot of these Fed speakers were not convinced that we'd have a cut this year, and now they're quickly falling in line. As it may be appropriate to pull forward our first rate move, he said. And when he asked if he favors more than one cut this year, he says it's in play. And so they got the message. And what I want you to understand is you're going to see Fed Chair Powell, now that he's communicated what he wants, all the other Fed speakers are going to get in line, and between now and mid-September at their next meeting, you're going to hear one after another validate that, yes, we are going to cut rates. They're going to tell the markets, get ready for this because it's coming. And the Atlanta Fed president said that inflation has moved a lot faster than I anticipated, and that the labor market has had a big change. So you can see they're afraid of this. With unemployment rising, though it is still solid, what they're afraid of is that it continues to move higher, and they're very desperate at the next report, which is coming on the 6th of next month. Of course, it's on a Friday. They're hoping to see some stabilization here. We know that's not likely to happen because the size of the first rate cut, a quarter point or half point, will depend on the data, Bostic said. If unemployment spikes in an unexpected way, we have to move bigger, he said. He also cautioned if inflation came in hot, that would argue for no move, but the reality is here, whatever the Fed chief says he wants, he's going to get. And yes, now the market is believing this, and you can see, as Morgan Stanley's Wilson says, it's about the labor data for the markets. At this point, it's not about inflation. We've seen the Fed cut into points where inflation is rising because they know if the labor market falls apart, that inflation is not the problem at all. It's going to go away. And Wilson says if we get another negative number, the market can react as bad as it did in July at the index level, so referring to the non-farm payroll report. However, a very strong payroll number could reverse that trend back to more cyclical parts of the market. But the reality here is whatever we see in that report, as long as the unemployment rate continues to head higher, watch out. It's game over for the Fed. They are going to cut. And if things get worse by the middle of next month, we might get a 50 basis point cut. And that is all we need to validate that the Fed knows we're headed into a recession. Because why this is bad news for the market, despite the fact that many market participants believe that cutting rates is great news. When you look at people hitting the unemployment line, there's two factors here. One, they stop investing. In some cases, they need money, so they pull it out. The second is their spending power decreases. That means, of course, corporate revenues, earnings, profits, all are going to come down. And when that happens, the market goes with it. Here you can see the NASDAQ 100 in blue against the unemployment rate. And as the unemployment rate rises, it's not a good sign for stocks, and in the past it usually reacts accordingly. This time the market said, look, we're bought in to this whole soft landing scenario and we're going to front run it. Only perhaps they're going to find out that that was indeed the worst possible move. But there is a little bright spot in the economy, and that's the housing market. As we see U.S. new home sales surge to the highest level since May of 2023, the pickup in sales suggests a combination of lower mortgage rates and generous sales incentives, there's a key one, by builders is starting to take root. Prospective buyers are finding more options in the new home market as the supply of existing homes is still very constrained. Asking prices are also more competitive compared to the resale markets because builders have a much larger margin to cut their prices. But is that going to help the housing market? Well, perhaps not, because the pickup in sales allowed builders to make a dent in inventory last month, which fell to the lowest since the start of the year. Nonetheless, at 462,000 homes for sale, it's near the highest since 2008. So many people believe that housing prices can't come down. But consider this, we hit a recession by the end of the year, demand goes away, you've got all this inventory that's sitting empty, they start to cut prices. Next thing you know, people out of work can't make payments. You've got the recipe for housing prices coming down. And at the current sales rate, that represents 7.5 months of supply, the lowest since September, but above pre-pandemic levels. Elevated inventory is helping to keep a lid on prices as the median sale price of a new home in July decreased 1.4% to just under $430,000. And prices have fallen on an annual basis in all but 1 month this year, indicating that indeed more disinflationary forces are coming. So while we got a little bit of a boost in housing, keep in mind all that inventory is going to come to haunt these builders when we head into a recession. And at this point, with Powell signaling a 0.25% cut at the next meeting, and perhaps a bigger one coming if the labor market falls out, it's now foregone conclusion we're headed into a recession. The only question will be, it's just how bad. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.